It will be a cold and dark one as Europe battles an energy crisis.
A looming energy crisis this winter.
Everybody needs energy security. These are all the things we need to have a stable standard of living. But what if we were not really in a supply-demand market? What if that wasn't really driving the prices, but Wall Street traders? Let's talk about that. Coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer. But what we really specialize in are building those custom strategies. And you know, we've talked so much about what is going on in the world, and my goal is to translate this financial noise because it's been handed over to traders. And do you really want traders that are guiding everything, especially energy, right? I mean, if I can't do what I'm doing right now and then transmit this out there through energy, then I don't get to help you as much as I would want to help you, because my world would be a whole lot more narrow, and so will yours. And unfortunately, I think we're gonna have to crash before anything comes up, because this is what we all need: secure sources of energy. And in this particular slide, you're seeing that I'm talking about Europe. But to be perfectly honest with you, this is a global issue. And even here in America, we are stumbling toward an energy crisis that is likely to be far more severe and long-lasting than the upheavals of the 70s. And I can remember those upheavals. I can remember the gas lines. So this is partly what you need to understand, is what that hidden threat to your energy security really is, because it is rearing its ugly head, not just in the energy markets, so that's the focus for today, but in all markets. When you give anything over to traders, all they care about is the trade. And you may think it's supply and demand driven, but it's not. So let's look at how energy gets priced. And, is that going to change? Probably not. Because absolutely everything has turned into a financial product that Wall Street can buy and sell really quickly and turn to make money. But you are the ones, and I'm the one, that is going to suffer the consequences of these choices. Europe is fighting to stave off an energy catastrophe that's threatening to become an economic, social, and even financial crisis. Nordic authorities moved this weekend to bolster the liquidity of utilities struggling with collateral requirements, saying there was a risk of a Lehman moment. You might recall that the Lehman moment was what imploded the whole ultimately. I mean, there were definitely things that happened before that Lehman moment in September 2008. But it was at that moment that overwhelmed the central bank's ability, even though they chose to let them go out, that really caused the great financial crisis. And what was behind all of that? Same thing that's going to be behind all of this. These are derivatives. Now, as a little refresher, a derivative is derived from an asset. It can be stocks, bonds, weather, energy, anything. And then it has no relationship to it. It's about the price movement of that underlying asset, real or even developed, because it can be against even other derivatives. So I'd like you to notice how these commodity derivatives impact these commodity prices, meaning energy and oil, because they do look pretty darn similar, don't they? This is trading, and you and I are the ones that will suffer and are suffering the consequences of this kind of pricing. Remember when oil went below, when negative $37 a barrel? We'll talk more about that. So now they're going to discuss gas price caps and a derivatives halt amid the crisis. Well, yeah, they have to, but there are so many, look, the derivatives market is actually, initially, it was a legitimate market. If I'm an end user, let's say I'm a farmer for a minute, and I'm going to grow a crop, and my crop is going to mature in September. I have no idea when I plant my crop, am I going to have a good crop? Am I going to have a bad crop? Am I going to be able to generate enough income to plant again? Or am I going to go out of business? So a derivative, a futures contract, and that's a derivative, sets the price in the future. And it's like an insurance policy, kind of like gold insures your wealth preservation. But the derivative, that futures contract, can ensure that I'm going to get my price for my crop. If I have a bad crop, well, then fine, that derivative is my insurance policy for my income, and I will be able to live to plant another crop. If it's a good crop, then it was just the cost of buying insurance, and it's not a big deal. But when traders get involved in it, then it's all about speculation, and they don't give a crap if I have a good crop or a bad crop. They only care about turning a profit. And is that really who you want to be determining the price of your energy or food or anything else for that matter? But this is what they're talking about for these new options to curb price spikes. I mean, don't get rid of derivatives, mind you. God forbid you should do anything like that. But to limit the impact of gas prices on power prices, so on the utility companies themselves, temporarily capping the price of gas used for electricity. Good, okay? None of this really makes sense. Price ceiling on Russian gas. Temporary exclusion of power production from gas and price setting on the electricity market. I gotta tell you, these are all the things that they do during hyperinflation that the government comes in and does. None of it ever works, but hey, let's do it again, why not? Urgent Europe-wide credit line for margin calls. You're getting a margin call if you're speculating and that price goes down. You have to come up with more capital where they sell out your position, which would even make it worse. Push the prices down even more. So they're going to allow you to borrow so that they don't have to sell off your position and make it worse. That's great, more debt, why not? Capping margin limits or price ceiling. Do you see what I'm saying here? Because there is a common thread on all of that, and that is the government coming in and putting limits on everything. Now, in a normal free market, would that really be a good thing? No, it would not really be a good thing. But the temporary suspension of European power derivatives market, so they're talking about halting the derivatives market. Let's wait until there's a big crisis to do it. Because after all, we can't regulate that. They were supposed to regulate that, but thanks to Greenspan, thanks for Larry Summers, who's on Bloomberg all the time now. He's such a big guy. He was instrumental in blocking the ability to regulate the derivatives market. So they created this huge monster, and now they're looking at capping everything. That's what governments do during hyperinflation. I got a real problem with all of this because they handed these markets over to the traders. And now at the end, when we're near a crisis, they're going to say, oh, wait, but don't look in the mirror and own your responsibility in it. Heaven forbid, they should not do that. And when these traders get involved, I'm telling you, it is all about the trade. It is all about making money. On April 20th, the price of a barrel of oil for delivery the following month plummeted $40 in an hour, settling at minus $37 a barrel. Now, I gotta ask you, in a normal market, if this were truly a supply and demand market, that would not happen. But this is a derivatives market, and the derivatives, in my really strong opinion and all of the research, that's what's going to overwhelm the central bank's ability to bail anything out. Because we don't even know how much is really at risk. When they give us a notional or nominal value, whenever you hear that word, those words, either one of them, then what you know immediately is you have no idea of how much they're really talking about. And the problem is neither do they. They make it really complicated. Nobody questions us. Well, guess what? They make it so complicated they don't have a clue what really is at risk. But regulators look into a small group of investors who got rich on the unprecedented drop. Perhaps they even created that drop. How many times have we read about JP Morgan traders or the London Whale or this or that or the other thing when these traders push the markets wherever they want the markets to go? And it could be energy, it could be food, it could be anything, because they only care about the trade. And this, you might recall, this is what that looked like. Minus $37 a barrel. This is recent history. When these things happen, it's a warning. And you can either ignore the warning or you can pay attention to it and get prepared. All of the things that are happening are telling you today, that we are in an extraordinarily precarious position and we don't know when the bottom's going to drop out. Now, that was just not that long ago, a couple years ago. This is today. These examples show how speculative traders control the markets. This particular group, EEX Group's global natural gas markets were up 128% year over year. Now, did the natural gas market really rise that much, or was it the trading? It's the trading. European gas spot markets. Spot market is a contract, whether it's gas or gold or silver. In this case, European gas spot markets were up 74% year over year. EEX recorded increases across all gas hubs, strengthening the price signal for these products. In other words, pushing those prices up. And we know what's going on in Europe with energy, and we're coming into winter, so it's pretty scary for a lot of people. The Dutch TTF, so that's an ETF, more than doubled. It's about trading. It's about turning a fiat money product. That's all it is. Trading on the European gas derivatives markets more than tripled. So that's where the demand came from. All of these contracts, because it is so much cheaper to trade a contract than it is to actually buy the product. So they're doing work in these gas derivatives, but do they ever intend to take possession of them? No, it's just about a trade. It's just about them making money. And as we've seen over and over and over again, they don't give a crap who they hurt in this process. German THE up 840%. The French PEG 569%. Austrian CEH 365%, and Dutch TTF 130. These are all derivative contracts. That's all they care about is the trade. And make no mistake about it, the governments and the central banks know all of this, and they actually have supported all of this because Wall Street is so much more important than Main Street. And that should be crystal clear, especially since 2008. And this is the kind of setup that puts us in position for the next Lehman moment. And I'm going to tell you this honestly. When I see the next Lehman moment, I will be up here in my bug out location and not be going back down to the valley until I feel like that's over. So, everybody always asks me, what am I looking for? Well, I'm seeing a lot of signs now, particularly in the government bond market globally, that let me know that we are very, very close to collapse. But when I see the activity of these traders and how they are really pushing around the global economy and hurting so many people, please tell me on what planet that's right or okay. Because for me, that is not. And what's happening too is clearinghouses. Now, EEX, which is in Europe, but this is true for all of the derivative houses. Many of them are also clearing houses, which means that trades are done through them. And I know that it's complicated, but they're kind of sitting in the middle of this hub and they're making trades, but they're also taking trades from all these traders around there. And they are clearing these trades. In other words, somebody wins. And there's always, in any trade, you always have a winner and a loser, right? You've got both sides. So EEX stands in the middle. They're not the only ones, but EEX in this example stands in the middle. And because they know what a precarious position the globe is, and particularly we're talking about Europe here, they're demanding more collateral. And you can see that right here, right? Here was the level of collateral and boop. So that is putting a pinch primarily on utilities that are using this as end users to guarantee prices. But this upward trend was only partly due to greater use of derivatives. So there were greater uses we talked about. But the primary driver was the step change in margin requirements that were implemented in March 2020, which was pretty much around the time that we saw oil go to minus 37 an ounce. So what this tells us is they know that a crisis is coming and they're trying to protect themselves by asking for more collateral, right? So that impacts the traders, but it also impacts the utilities that are actually providing the energy, and it creates a big problem for them. So you can see this. A recent BIS is the Bank for International Settlements, so that's the central banker's central bank. And that report found that the amount of collateral held to meet initial margin requirements increased by 62% between February and the middle of March. So that's not very long, maybe a month and a half. The clearinghouses are preparing for a crisis. Does that mean that this is even going to be enough in this next crisis? We're going to find out. Personally, I don't think so. This next one is bigger than what happened in 2008, because what happened during that period of time is central banks and governments, but particularly central banks, stepped in with QE and QE 1, 2, 3, 4, and reverse this and that, and all this fancy stuff, and they ballooned their balance sheets to nosebleed levels. And they are attempting slowly to run off that balance sheet, which they can't really do because that impacts the price. I mean, these central bankers and these governments have really put themselves between a rock and a hard place. And quite honestly, they're going to be damned if they do and damned if they don't. It doesn't really matter. This is where we're at. It's part of the reason why I say this is the end of the current iteration of this fiat money life cycle. And you better be ready, because if you're not, then you're going to have to accept the garbage that they're going to shove down our throats, which is a central bank digital currency. And if that is our only choice, I'm going to tell you right now, you're not going to be happy with that choice. And this is what's happening. Energy trading stressed by margin calls of 1.5 trillion. That is a notional amount, right? None of this tells us how much is really at risk, and you really need to get that. Exchange requirements to secure trade is sucking up capital. So the money that the utility companies actually have to use to produce energy for yours and my home, they got them off grid here, but that is putting a huge pressure on these utility companies, even though it's really the traders that are creating this problem. The utility companies are the end users. They're trying to survive another day, but it's gone from single digits to triple digits. And here's the piece. It's all about liquidity, the ability to buy and sell and not move the price enormously. Liquidity support is going to be needed. In other words, they're going to need the central banks and the governments to come in and give them money for these margin, which they said that they were going to do. The issue is focused on derivatives trading, while the physical market is functioning, he said, adding that the energy companies' estimate for $1.5 trillion to prop up so-called paper trading is conservative. Do you see what I'm starting to talk about here? This is all about liquidity. And if that liquidity dries up, that was the Lehman moment. That's what happened. The liquidity, boom, 24 hours. Remember that? Gone. A lot of these traders weren't even around in 2008, let alone in Black Monday in 1987. I was there. I can't even tell you how thankful I am that I'm as old as I am, that I got a chance to live through the currency conversion from a quasi kind of gold-backed currency into a debt-backed currency. And I never really thought that I would live to see, frankly, going into a CBDC, but I'm grateful to be here so that I can help you understand it. And I know this stuff is complicated. What you really need to understand is that this is just about traders making money, and you and I are the ones that pay for it. Yeah, liquidity support is going to be needed. It's about derivatives. I've talked to you ad nauseum that the derivatives market is going to topple everything because it's kind of like an iceberg. You know, they report, it's whatever, 610 trillion in notional value derivatives. But that after they net things out and they do this fancy accounting over here and this fancy accounting over there, we have no clue. We have no clue about the tsunami of bets that will overwhelm us and take this whole system down. 1.5 trillion? Yeah, that's conservative. I bet so. But understand that that impacts the utilities that provide the energy for us. Europe's Lehman warning on energy prompts a flurry of cash aid. Price jumps are increasing margin calls. This is all about traders. I can't say that enough. That's what you and I are saying is kind of okay to price our utilities, our food, our gas, everything. Multiple governments are offering credit lines and loans to help. This is Dutch front-month gas futures margin have soared tenfold in the past year. And so the ECB provides liquidity. That's new money. They're making new money at the same time that they're raising rates. Do you see why I'm saying they're between a rock and a hard place? And there is no good policy move for this because they've put themselves and us in this position where they're damned if they do and they're damned if they don't. It doesn't matter what they do. It has gone past that point of return. The can is now at the end of the road. And I cannot say it more clearly than that. You know, they're providing liquidity, they're taking it away. What is that? Right? That's like completely schizophrenic. And it won't work. So I hope you can see the problem because you need to get ready for it. Finnish Utility Forum got 2.35 billion euros of bridge funding, and they're an end user. That's the utility company. So these traders are taking the real asset, the real hard asset, and they've done it in real estate, they've done it in everything. The whole world is now just one big Wall Street. And whether or not you realize it, we don't have any options other than getting as independent and self-sufficient as possible. I mean, honestly, I've done a lot of work to be in that position. Do you think that's really what I wanted to do? Heck no, I was getting ready to retire in 2008. I had a little condo, I could lock it up, I could travel, I could do all of that, and then 2008 happened. And I went, holy crap, this is the end, I'm not going anywhere. And so instead I bought a property big enough for my children, and I started growing food. I became an urban farmer. I never wanted to be an urban farmer. And then when March 2020 happened and April happened, and I'm walking around and I'm like feeling so good because I didn't worry about food or toilet paper or anything like that. But there were riots right near my house. There were riots right near my children's house. And I slept that night with a gun in my bed. And I thought, there's the hole in my strategy. So now I put a lot of money and energy into my bug out house that is off grid. It's critical. We need to be paying attention, and we need to all be moving forward as quickly as we can. How do you eat an elephant? One bite at a time. I know I say that all the time, but it's just true. So now a Nordic utility, 33 billion euro backstops as power markets fray. Now, as you recall from a couple slides ago, the physical markets are working just fine. It's the spot markets, the contract markets that are creating all of this turmoil. Yeah, they'll create a whole lot more. This is an end user, and as a reminder to you, these are derivatives in the US in the FDIC insured banks. This goes back to 2000 when the speculative derivative market really started. And Larry Summers and Alan Greenspan, and I can't remember the other guy, blocked oversight of this market and created this monster and this beast. So here's 2008, and this is where the derivatives market is. All these derivatives that were created back here, derivatives, most of them have never settled out, which is why they're still there and this level is so high. They're called legacy derivatives because most of these derivatives were done between two entities, maybe three, right? So they're all unique. They can never settle out. So what they have to do is just keep paying these fees to keep them floating. Well, what if the margin calls that are created become so big that all of these legacy derivatives are now turned out into the market? There's no overcoming this. There is no overcoming this. And remember, we're getting real close to 2023 when every contract has to be tied to SOFR, because the interest rate derivative contract, LIBOR, that was discovered of being manipulated, is going away. So they've been furiously trying to modify all of those contracts. Can they get all of them done? They only have a couple more months. I mean, 2023 is going to be a really interesting year. 2022 has been a very pivotal year. Can this whole thing hold together till 2023? I don't know. But I'm going to tell you, you want to get ready while you still have choices. To hammer this home, here's your end users, right? I'm a farmer, I'm a utility company, I'm something like that what I'm trying to do is just ensure that no matter what happens to the price, I can live to operate another day. And these are all speculations. Now, in 2013, they changed the accounting procedure. And so you can see that the derivatives went down, but they're still higher than 2008. And this is an opaque market. It's absolutely opaque. We have no idea the true value at risk. And I got to ask you, which trader type do you think is going to control the markets? This little end user down here? Or these speculators up there that only care about the trade? Not you, not me, not if hundreds of thousands of people die this winter because they cannot afford to heat their homes. A reminder of the Lehman moment and just how quickly liquidity dries up. Boom. Just like that. Just like that. We got the warning. Well, we got the warning in 2005 that the real estate market was toppy. 2007, that's when the dollar fell to the lowest level ever against other currencies. Something nasty this way comes. We were warned. Did you pay attention? Will you please pay attention now? Because I don't know how many more warnings we're going to get. And the bottom line is traders don't care about you or me or your babies. They just care about the trade. And they will do anything for the trade. Lie, cheat, steal, doesn't matter. Anything for the trade. For me, I'm anything for the people that I love. And what's the government doing again? They're ignoring it. Ignoring it. In recent years, European utilities have fallen into the habit of using derivatives to lock in the price of their future electricity. And I love this too, because what they're really putting the blame on are the utility companies, when it's really the speculators. But look over here, because that way you won't look over here. I'm telling you, I hate these guys. Okay. Of using derivatives to lock in the price of their future electricity sales before actually serving consumers in order to protect themselves against possible price falls. Since electricity prices have obviously surged, not fallen this year, utilities do not actually need this protection. But they can't cancel the contracts, and the price surges have created massive paper losses, and the exchanges are now trying to protect themselves against the risk by demanding that the utilities post collateral, which would normally come in the form of cash. So that means that the utility companies that are providing utilities to the end consumer are extraordinarily vulnerable. Will there be nationalization? Well, yeah, I think that's happening already. Let's talk about this a little bit more in just a minute. But who provides the collateral? To meet the exchange's collateral requirements, large utilities typically rely on established revolving credit facilities with their banks. Notice how they don't say that these entities rely on debt, on the ability to take on more debt. If you see credit, you think debt. You should. Okay, because that's what credit really is. It's the ability to grow more debt. Additionally, there are signs that some are reaching the limits of their commercial credit lines. So what happens if the traders keep pushing the price up and these utility companies can't come up with additional collateral? Does that mean that the energy that they're providing is going to be more spotty or more challenging to actually provide? Now, politicians' criticism that the markets are malfunctioning have put the spotlight on the main market operators for energy futures. Futures equals derivatives. In Europe, NASDAQ, well, that's a familiar name. In Sweden for electricity, ICE futures in Europe, another familiar name, in London for oil, and in Amsterdam for gas, and Germany's EEX for electricity. See, they're all incestuously intertwined, whether you're in the US or you're in Europe or it doesn't matter where you are in the world. You want globalization, we got it. I'm going to show you in just a second. But these same guys that create these derivative markets also run the clearinghouses that manage the risks and exposure on open derivative contracts, calculating payments every day that determine how much margin customers put down. So, it's the fox watching the hen house. They create these monsters and then they manage these monsters and they make money. No matter what happens, they make money. So let me just remind you of the globally interconnected financial system. And a couple weeks ago, I even showed you deeper levels of interconnection. So that's why what's happening in England or what's happening in Europe, it's not going to stay in England or in Europe. And we're not so pristine anyway, but it's going all over the place. So let me just show you this, because there's the CME, which they just mentioned. And by the way, did I put DTC? Yes, I did. DTCC is another clearinghouse. Now, you may recall from past videos, and if you need to be reminded, just let me know and we'll put this up. But DTCC is actually the legal registered owners of all and any pretty much any securities that you hold at a brokerage account, because they are most likely held in what's called street name. If you don't know this for sure and you've got an account, you might want to call your broker and say, are my securities being held in street name? Because if that is indeed the case, which my bet would be it is, unless you ask for something otherwise to be held specifically in your name, then DTCC is actually the legal registered owner. You're just the beneficial owner. And every entity between DTCC on the top and you on the bottom is also a beneficial owner. Now, what does that mean? That means that they get to take your equity, whatever equity you have in that account, and use it for their benefit. So in other words, use your equity as collateral to borrow. And as long as they do this contract through the City of London, which is by far where most of them are done, there are no limitations as to the number of entities that can use that same collateral. And there are no limitations on how many times that same collateral can be used. And taking you back to 2008, who went to jail? Nobody, because it's legal. Should it be legal? In my opinion, no. But, we've already seen many times corporations are far more important. There's ICE again, there's LCH, there's Deutsche Bank in the middle, and you can see all of these gray lines. This is how everybody's completely interconnected. So it doesn't really matter. And over on the other side too, the same entities, the same. Globalization created an interconnected world. And that crisis, this next one that's coming up, this is how it spreads. Now you can say, well, I don't even know who those guys really are. How are they going to impact me? Well, let's take a look at how they impact you. Because not one person on this planet, not one, is going to be immune from this crisis. First of all, the crisis is really the death of the current monetary system. But here are all those same guys, CME, ICE, this LCH, but you can put any of them on there. It doesn't really matter. And what's the next layer below them? All these banks, all of the banks. I mean, there's just a handful. You saw all the interconnected gray lines in between. But I don't know, do you have an account at Barclays, UPS, Bank of America, Credit Suisse, Societe Generale, Deutsche, Citigroup, BNP, HSBC, RBS, JP Morgan, Morgan Stanley, Goldman Sachs, Wells Fargo? You got an account in any bank? How about any credit union? How about any small local community bank? Because the credit unions and the community banks have to go to these guys, these commercial banks, to get their money. So it doesn't really matter where you are, everybody's going to feel it. And these banks So the commercial and investment banks are tied into, like I said, the community banks, credit unions, hedge funds, insurance and pension plans, central banks, and sovereign wealth funds, non-financial institutions. So can you see how this can spread globally in this globally financialized world? And they're talking about deglobalization. Well, that's only on some levels. Actually, I'm going to be talking next week about the CBDC, central bank digital currencies, and I'm going to show you in that piece how maybe you're hearing a lot about deglobalization. Look over here, because over here we're going to make globalization even stronger. Great. I feel so good about that, don't you? In the meantime, when you're looking at these financial fiat money products that can be created at whim with a click of a button, you've got to be looking at the price of gold, right? Price of silver. Oh my God, it's down so much. Well, why? Because a rising gold price is an indication of a failing currency, because gold is good money and dollars are not. Euros, all of that. That's debt-based money. So you've got good money, you've got debt-based money. Do they want you to switch out of your debt-based money and go into good money? Heck no, they don't. But anytime you get anything physical, I don't care what it is, it can be a mug, it can be gold, it can be whatever it is. As long as it's physical, there's a finite amount of it. Whether it's in the ground, above the ground, there's a limited number of trees, anything physical, there's a finite amount. And over the last couple of years, what we've seen is that gold mine production worldwide has been declining. Can we go back to the slides, please? Thank you. In the real world, there's a finite amount of gold, and it takes energy and effort to pull it out of the ground. And I know that I'm using this next graph a lot, but I'm really trying to hammer home how easy it is to create gold that does not, and silver too, because this is precious metals, that does not nor ever will exist, and then thusly push that visible price that you see down, because all these are contracts. They're not real. This is definitely more real. This are just contracts. Because frankly, Wall Street has turned every single physical asset that there is into a financial product. And then once it's a financial product, it's easy to trade, right? You're not going to buy the gold. You're going to spend $150 and control $1 million worth of gold. That's leverage. But what goes up must come down. And what's happening right now is that these derivative trades are starting to unravel. And we are in a really, really, really precarious position. Most of the derivative trades out there are against interest rates. And central bankers globally are bent on raising interest rates. Whether or not that's really going to help any inflation, which they admit it's not. But they're doing it anyway. And so when you really look at everything, even the spot market, because that's all they're showing you. I can tell you this, I can promise you this, because time after time after time historically, what happens is that all assets end up at their fundamental value, their true value, based on the most important function that they perform. And with gold, its most important function is to hold its assets, its purchasing power value over time. They can manipulate it down short term, but long term they cannot. So 1,000 years ago, an ounce of gold would buy a great suit of armor. In the early 1900s, an ounce of gold or a $20 bill would buy a really nice men's suit. Even where it is at the moment, 16 something, you can still buy a really nice men's suit for the spot market. Why haven't they hammered it even more? Because it costs money to pull it out of the ground. But I'm going to tell you without a doubt, this is not the time to be speculating on anything. This is the time to be safe. Food, water, energy, security, barterability, wealth preservation, community, and shelter. Do yourself a favor, get it done. And I have to tell you, if you have not yet called us to get your own plan put together, your custom plan put together, well, just click that Calendly link below and set aside a time to talk to one of our consultants. And if you haven't done so already, make sure you subscribe so you can hear this kind of material, because ignorance doesn't make you immune. It just leaves you vulnerable. And it is not a good time to be putting your head in the sand. It's a time to be proactive. And honestly, I'm going to wish you please to be safe until next we meet. And until then, bye-bye.